Let us move ahead and take up the next question. That will be question number 19. Let us read this question first. Annual sales of A Limited all on credit is rupees 3 crore 60 lakhs. The company offers 3 months credit to its customers. Currently bad debts are 2% of total credit sales. Cost of collection incurred by the company is rupees 30,000 per month. The company is thinking of appointing a factor who would make collections from the debtors of the company and charging fees of 5%, that is collection from the debtors of the company by charging 5% fees. The factor is also willing to advance 80% of the receivables at interest rate of 15% per annum. You are required to determine the effective annual cost of factoring under the following cases. Case 1, interest and fees charged by the factor at end of each cycle, and case 2, interest and fees charged by the factor at the beginning of each cycle. So let me check your answers now. Case 1, interest and fees charged by the factor at end of each cycle. So average balance of debtors will be 3 crore 60 lakhs into 3 by 12, that is 90 lakhs. Amount advanced by factor will be 80% of this, that will be 72 lakhs. Let us move ahead and compute the cost of factoring per year under this case 1, and you will begin with the factor fees, that will be 5% of 3 crore 60 lakhs. Then interest charged by the factor will be 15% of 72 lakhs. Aggregate of these two will be 28 lakh 80,000. From that you subtract the savings in bad debts and also subtract the savings in administration and collection cost, and that will be 3 lakh 60,000. So subtracting these two components, your net annual cost comes to 18 lakhs and the annual effective cost of factoring will be 25%. Let us go ahead and deal with the second case. So you will write the heading as case 2, interest and fees charged by the factor upfront. So average balance of debtors 3 crore 60 lakhs into 3 by 12, 90 lakhs, that remains as it is. But this time one thing will change. Amount eligible for advance remains 72 lakhs, that is 80% of 90 lakhs, but this is not the amount advanced by the factor. Factor will first deduct the fees for that cycle, that will be 5% of 90 lakhs, 4 lakh 50,000, and for computing the interest the base will be 67 lakh 50,000, and upfront fees charged. After deducting that upfront fees, when you compute interest will be computed as 15% on 67 lakh 50,000 for 3 months, that is into 3 by 12, and that amount of interest comes to 2 lakh 53,125. After deducting this amount of interest, what you get is the net amount actually advanced, and that will be 64 lakh 96,875. Let us go ahead and write up the main part of the solution, that will be cost of factoring for the year, and factor fees doesn't change on an overall basis, but the interest charged by factor will be 15% of 67 lakh 50,000, that will be 10 lakh 12,500. Aggregate this time is 28 lakh 12,500. You will subtract the savings in bad debts and also subtract the savings in administration and collection cost. These two amounts of savings do not change whether it is case 1 or case 2. The net annual cost comes to 17 lakh 32,500. This will be divided by the net amount actually advanced to compute the percentage, that is the annual effective cost of factoring by percentage. Let us go ahead and take up the next question, that will be question number 20. Let us read this question. A Limited has total sales of rupees 3.2 crores and its average collection period is 90 days. The past experience indicates that bad debt losses are 1.5% on sales. The expenditure incurred by the firm in administering its receivables collection efforts are rupees 5 lakhs. A factor is prepared to buy the firm's receivable by charging 2% commission. The factor will pay advance on the receivables to the firm at an interest rate of 18% per annum after withholding 10% as reserve. Calculate the effective cost of factoring to the firm. So friends, when you are reading this question, what you need to typically understand, look at that one particular line given over there. It says a factor is prepared to buy the firm's receivables. When the factor is buying the firm's receivables, means every penny of loss that may arise from that will simply be the loss borne by the factor. In other words, any bad debt losses arising, it will be the loss of the factor. Means it is clearly given that the factoring is on a non-recourse basis. This time you don't have to make an assumption. It is an indirect way of communicating to you that the factoring is on non-recourse basis. Now, as far as the factor fees and interest, the question is silent. So you can have two different assumptions, that the fees and interest is collected by beginning of each cycle or by end of each cycle. So if you have to take any one assumption, you should take that assumption which ICAI prefers. ICAI always prefers that in absence of information, the interest and fees will be collected by the factor upfront. Keeping that thing in mind, I want you to try out this particular question. So of course, this question I will in fact guide you how to approach the entire solution, and when it comes to the next question, which will be a similar question to this one, I'll give you an opportunity to try out that. So I have explained you two important things while reading this question. Number one, because the language used over here is that the factor is buying the firm's receivables, it means indirectly conveyed to you that the factoring is on a non-recourse basis. Bad debt losses will be borne by the factor. So the firm will have savings in bad debts for sure. Regarding the other point that I have told you, when the question is silent about the collection timing of this factor fees and the interest, you will follow same line of assumption that is followed by ICAI, and that is upfront collection of fees as well as interest. So keeping that notion in your mind, so you don't have to solve this question two times, you have to solve it just once, assuming that the factor is collecting the fees and interest upfront. So let us see how to write up the solution for this question. In your solution, what you will first do is, you will compute the average balance of debtors. Average balance of debtors will be 3 crore 20 lakhs into 90 by 360, that gives you 80 lakhs. The factor is going to maintain a reserve of 10%. So the amount eligible for advance will be 72 lakhs. Thereafter, the factor is collecting the fees upfront. So here you have to be cautious. It will be 2% of the debtors balance, because in each round of this collection there will be 80 lakhs of debtors that the factor is going to collect, and therefore the factor fees for each cycle will be 2% of 80 lakhs, and that comes to 1,60,000. Subtracting that, you get 70,40,000 as the base for calculating interest. Now you will compute the upfront interest, and that will be 18% of 70,40,000 into 90 by 360, and after subtracting that interest, you get 67,23,200 as the net amount actually advanced. Let us move ahead and write up the last part of the solution. So that will be cost of factoring for the year. Factor fees will be 2% of 3 crore 20 lakhs, and that will be 6,40,000. Interest charged by factor will be for the entire year 18% of 70,40,000. That comes to 12,67,200. And from this aggregate, you subtract the savings in bad debts and also subtract the savings in administration and collection cost, and what you get is the net annual cost of 9,27,400. And when you compute annual effective cost of factoring, what you get is 13.79% per annum. Let us move ahead and take up the next question, which will be the last question in this topic. Question number 21. Let us read this question. MSN Limited has total sales of rupees 4.5 crores and its average collection period is 120 days. The past experience indicates that the bad debt losses are 2% on sales. The expenditure incurred by the company in administering its receivables collection efforts are rupees 6 lakhs. A factor is prepared to buy the company's receivables by charging 2% commission. Factor will pay an advance on receivables to the company at an interest rate of 18% per annum. After withholding 10% as reserve, calculate the effective cost of factoring to the company. Let us see what will be the answer for this question. When you begin the solution, you start with the average balance of debtors, that will be 120 by 360 of 4 crore 50 lakhs, and that comes to 1 crore 50 lakhs. From that you subtract the amount withheld as reserve, 15 lakhs. So amount eligible for advance will be 1 crore 35 lakhs. From this you will subtract the factor fee that is collected upfront for each cycle, that will be 2% of your average debtors balance. 2% of 1 crore 50 lakhs is 3 lakhs. Then you get the net amount as 1 crore 32 lakhs, which will become the basis for computing the interest, and then the amount of interest can be calculated as 18% of 1 crore 32 lakhs into 120 by 360, and that comes to 7,92,000. Because even the interest is collected upfront, the net amount that will be actually advanced will be 1 crore 24 lakh and 8,000. Let us move ahead and write up the cost of factoring for the year. In the usual way, factor fees 9 lakhs, interest charged by factor will be 23 lakhs 76,000. This will be for the entire year. From this aggregate, subtract the savings in bad debts and also subtract the savings in administration and collection cost, and what you get is net annual cost as 17 lakhs 76,000. Effective cost of factoring will be 14.31% per annum.